Billions of dollars in retirement savings disappear every year because of simple mistakes. Inherited IRAs are a major reason for this financial loss. These accounts confuse many people after a loved one passes away. The rules changed dramatically in 2020. Before that year, an inherited IRA could be stretched over a beneficiary's lifetime. This meant smaller yearly withdrawals and more tax-deferred growth. But the Secure Act changed almost everything. It passed in 2019, but took effect in 2020. Now, most non-spousal beneficiaries must empty the account within 10 years. This 10-year rule applies to anyone who inherited an IRA after 2019. It causes a big shock for many families. People expected to stretch out their money for 30 or 40 years. Suddenly, they face a 10-year deadline. This can mean much larger taxable distributions. For someone in a high income tax bracket, this is a major problem. Imagine inheriting $1 million over 10 years, that is $100,000 a year in income. That pushes many into higher tax brackets, perhaps from 24% to 32%. This is a big tax hit. There are different kinds of beneficiaries too. A spouse has the most options. They can roll the inherited IRA into their own IRA. This is called a spousal rollover. It lets the money continue to grow, tax-deferred for decades. The spouse then takes required minimum distributions, or RMDs, based on their own age. This is the most flexible choice. For example, a 70-year-old spouse inheriting an IRA might only take out 3% of the balance each year. A second option for a spouse is to treat the IRA as their own inherited IRA. They would follow the 10-year rule, but might wait to take distributions. A third choice is to keep the IRA as an inherited IRA. This is done in the deceased's name. The spouse would then take RMDs based on their own life expectancy. The choices for spouses are much better than for others. This gives them significant financial flexibility. Other people are called non-spousal beneficiaries. This includes children, grandchildren, siblings, or friends. Most of these individuals fall under the 10-year rule. If the original owner passed away in 2020, or later, the account must be fully distributed by the end of the 10th year. This does not mean equal annual distributions. It just means everything out by year 10. Some people think they have to take 1/10 of the money each year. This is not true. They can take it all in year 10 if they want, but this could lead to a massive tax bill. For example, taking $1 million in one single year could mean half of it goes to taxes. That is a $500,000 tax payment. Many people are not ready for this. A 25-year-old inheriting a large IRA might suddenly owe hundreds of thousands in taxes. This drastically reduces the inheritance's value. There are exceptions to the 10-year rule. These are called eligible designated beneficiaries. This group includes surviving spouses, as discussed. It also includes minor children of the original account holder, but this is where it gets tricky. Once a minor child reaches the age of majority, typically 18 or 21, the 10-year clock starts ticking. So a child who inherits at age 8 would have until age 18 or 21 plus 10 years. That is a maximum of 28 or 31 years. This is still better than a straight 10-year period. Another exception is an individual who is chronically ill or disabled. There are specific IRS definitions for these conditions. A doctor's certification is often needed. A person who is not more than 10 years younger than the original owner also qualifies. This often includes siblings or close friends who are around the same age. For these eligible designated beneficiaries, the old stretch IRA rules still apply. They can take distributions over their own life expectancy. This preserves the tax benefits much longer. It allows for decades of continued tax-deferred growth. Many people do not know the difference between traditional and Roth IRAs when inheriting. A traditional inherited IRA means withdrawals are taxed as ordinary income. This is the biggest surprise for most. The money was often contributed pre-tax, so it was never taxed before. Now it is income to the beneficiary. This can add $20,000 to a $40,000 annual income. A Roth inherited IRA is different. The original owner contributed money post-tax, so qualified withdrawals from an inherited Roth IRA are usually tax-free. This is a huge advantage. There are still RMD rules for inherited Roth IRAs, though. Even tax-free money still needs to be withdrawn. For non-spousal beneficiaries, the 10-year rule applies to Roth IRAs too. They must empty the account within 10 years, but at least the money comes out tax-free. This makes Roth IRAs much less confusing to manage after inheritance. It removes the income tax shock. The penalty for missing an RMD or not emptying the account on time is severe. It used to be 50% of the amount that should have been withdrawn. For example, if someone was supposed to withdraw $10,000 and they did not, the penalty was $5,000. The IRS reduced this penalty to 25% in 2023. For an inherited IRA not cleared in 10 years, the entire remaining balance could be subject to this penalty. Imagine an inherited IRA with $150,000 left after 10 years. If it should have been fully distributed, the penalty could be $37,500. That is a massive loss for a simple oversight. Many people get professional help to avoid this. Financial advisors and tax professionals understand these complex rules. They help families make the best choices. This professional guidance can save tens of thousands of dollars for families. Beneficiary designations are critical. If there is no named beneficiary, the IRA might go through probate. This adds legal fees and delays. The default beneficiary rules then apply. These rules vary by state and by IRA custodian. Often, the estate becomes the beneficiary. This is usually the worst outcome for tax purposes. An estate may have even shorter distribution periods than a 10-year rule. It might be 5 years in some cases, or it could be based on the original owner's age at death. If the original owner died before their required beginning date for RMDs, usually age 73, then a 5-year rule might apply to the estate. If they died after their RMD date, then the account might need to be distributed over their remaining life expectancy. This is even more complex. Always name a primary and contingent beneficiary. This prevents a lot of headaches later on. It ensures your money goes where you intend. The required beginning date for RMDs also shifted recently. It used to be age 70 and a half, then it went to 72. Now for people turning 72 after 2023, it is age 73. This applies to the original IRA owner. It does not directly impact inherited IRA rules, except for determining if the original owner had started RMDs. If an IRA owner dies before their required beginning date and they have a non-eligible designated beneficiary, the 10-year rule applies. If they die after their required beginning date, the 10-year rule still applies to non-eligible designated beneficiaries. The only time the date really matters is for eligible designated beneficiaries and for estate beneficiaries, as mentioned earlier. These small shifts in age create big confusion. Trusts can also be beneficiaries. This is incredibly complex. A trust can be a designated beneficiary if it meets certain requirements. It must be irrevocable. All beneficiaries of the trust must be individuals. The trust document must be provided to the IRA custodian, and the trust beneficiaries must be identifiable. If the trust qualifies as a look-through trust, then the life expectancy of the oldest trust beneficiary can be used for distributions. But this is rare now under the 10-year rule. Most trusts inheriting IRAs after 2019 will also face the 10-year deadline. Trusts are often used for minor children or special needs individuals. They add layers of complexity for inherited IRAs. Mismanaging a trust as an IRA beneficiary can lead to huge tax consequences. Getting expert legal and financial advice is non-negotiable here. A single legal misstep could cost hundreds of thousands. One common misconception is about the age 59 and a half rule. This rule applies to your own IRA. It means you can withdraw from your own IRA without penalty after age 59 and a half. This rule does not apply to inherited IRAs. As a beneficiary, you can withdraw from an inherited IRA at any age without the 10% early withdrawal penalty. However, the distributions are still taxable if it is a traditional IRA. So an 18-year-old could inherit an IRA with $50,000 and start taking money out. They would not pay an early withdrawal penalty, but they would pay income tax on those withdrawals. This is a crucial distinction many people miss. They think they must wait until age 59 and a half. This is just not true for inherited accounts. This gives younger beneficiaries more immediate access. The IRS has provided some relief on RMDs for 2021 and 2022. They clarified that if the original owner died after 2019 and was already taking RMDs, a new RMD was required for the beneficiary in years 2021 and 2022. Many people thought the 10-year rule meant no RMDs until year 10. The IRS later stated this was incorrect for certain situations. This caused a lot of confusion and anxiety. The penalty for missing these RMDs for those specific years was waived for many people. But it highlights how quickly rules can change or be clarified. Staying updated on these tax laws is almost impossible for the average person. Financial planning services are essential for proper management. This demonstrates the constant flux in regulations. The amount of money in inherited IRAs is truly massive. Trillions of dollars sit in these accounts across the United States. Each year, hundreds of billions of dollars are passed down. For example, in 2021, over $350 billion were transferred through inheritances. A significant portion of this involves IRAs and other retirement accounts. With so much money involved, the stakes are incredibly high. Mistakes can easily cost tens of thousands or even hundreds of thousands of dollars. It is not just wealthy families who face these issues. Even middle-class families with $100,000 IRAs can face significant tax burdens if they mismanage an inherited account. The rules do not care about the size of the inheritance. They apply equally to all. Every dollar is scrutinized. Many families discover these rules only after a problem arises. They receive a statement from the IRA custodian, it might show a deadline approaching, or they file their taxes and get a surprise bill. Sometimes a family learns about a missed RMD from a notice about a 50% penalty. This is a very upsetting experience. Losing half of a required distribution to a penalty can feel unjust. But the law is clear. Ignorance of the law is not an excuse. This is why proactive planning is so important. When someone sets up their IRA, they should think about who their beneficiaries will be. They should also consider how those beneficiaries will manage the account. A little planning up front can save future generations a lot of money and stress. It is a critical aspect of generational wealth. The difference between a primary and a contingent beneficiary is also vital. A primary beneficiary is the first person to receive the funds. A contingent beneficiary receives the funds if the primary beneficiary cannot or does not. For example, if a spouse is the primary beneficiary and they pass away before the IRA owner, then the contingent beneficiary steps in. If no contingent beneficiary is named, the money again goes to the estate. This causes all the problems mentioned earlier. Regularly reviewing beneficiary designations is a smart move. Life changes, marriages, divorces, births, deaths. Each event might warrant an update to these designations. Financial institutions usually have simple forms for this. It takes just a few minutes but has massive financial implications. This small step can prevent disaster. Some people try to transfer inherited IRAs to other investment accounts. This is generally not allowed. An inherited IRA must remain an inherited IRA. It cannot be rolled over into your own IRA unless you are a spouse. For non-spousal beneficiaries, the inherited IRA must maintain its inherited status. It might be moved from one custodian to another, for example, from one bank to a different investment firm, but it remains an inherited IRA in the deceased's name. For benefit of the beneficiary, it cannot be mixed with the beneficiary's own retirement savings. This separation is important for tracking RMDs and tax treatment. Trying to combine them could lead to immediate taxation of the entire account. This is a common trap for the uninformed. This mistake can cost everything. The complexity of these rules seems designed to confuse. One might wonder why it is so difficult. The goal of retirement accounts is to encourage saving, but when the money is passed on, the rules become about taxation and distribution. The government wants its share of the deferred income. This is why the 10-year rule was enacted. It speeds up the taxation process for most inherited accounts. It means more money in tax revenue for the government sooner. This might sound cynical, but it is a practical reality. The rules are not just about helping beneficiaries, they are also about how and when the government collects taxes. Understanding this underlying motivation helps grasp why the rules are so strict and complicated. It is all about the money. Even charitable organizations can be beneficiaries. If an IRA is left to a qualified charity, the charity does not pay income tax on the distributions. This can be a very tax-efficient way to leave money to charity. It avoids income tax that individual beneficiaries would have to pay. For someone with a large traditional IRA who wants to support a cause, naming a charity as beneficiary can be a smart move. The charity receives 100% of the money, no income tax is withheld. This is especially useful for older individuals who might not need their IRA funds for living expenses. They can leave their children other assets and use their IRA for charitable giving. This bypasses a lot of the inherited IRA confusion for family members. This provides a clear path. Estate planning involves more than just IRAs, but inherited IRAs are a frequent point of contention. People often spend years carefully building their retirement nest eggs. They plan for their own future, but they might not plan enough for the future of their beneficiaries. A simple will often does not cover beneficiary designations for IRAs. These accounts pass by contract to the named beneficiary. They do not pass through a will. This is a critical point. Someone could have a will saying their children get everything, but if their IRA names their ex-spouse as beneficiary, the ex-spouse gets the IRA. The will is irrelevant for that specific asset. Always check your beneficiary forms. This is one of the easiest ways to ensure your wishes are followed. A 5-minute review can prevent years of regret. Many people also confuse trusts with designated beneficiaries. A trust can be a designated beneficiary, as mentioned, but it is not the same as naming an individual. The rules for trusts are much more stringent. For example, a conduit trust only allows for income to be distributed to the trust beneficiaries. The principal must stay in the IRA until the 10-year rule forces it out. A discretionary trust allows the trustee to decide when and how much to distribute. This gives more control, but also adds fiduciary responsibility. The trustee must understand all the inherited IRA rules to avoid mistakes. Many trustees are lay people. They might not have the financial or legal background to manage such complex accounts. This is another reason why expert advice is invaluable. This is not a task for an amateur. The frequency of changes to these rules also adds to the confusion. The Secure Act in 2019 and the Secure Act 2.0 in 2022 brought significant updates. The age for RMDs shifted, new exceptions for certain beneficiaries were created, the 10-year rule became a default. Staying current is a full-time job for financial professionals. For a family simply trying to manage a loved one's estate, it feels like a moving target. The IRS also issues guidance and clarifications that can change how previous rules were understood. This happened with the RMDs for 2021 and 2022. People had to scramble to adjust. This dynamic regulatory environment makes planning incredibly difficult without continuous expert support. It is a constantly evolving. The financial consequences of poor planning are real. Missing a deadline for an RMD means 25% of that amount is lost to penalties. Misunderstanding the 10-year rule can lead to a huge income tax bill in a single year. Naming an estate as beneficiary can mean the entire IRA is taxed at a much faster rate. These are not small sums. For an average inheritance of $150,000, one wrong move could cost tens of thousands of dollars. For larger inheritances, the losses can be hundreds of thousands. It is a stark reminder that legacy planning extends beyond simply saving money. It also requires understanding how that money will be handled after you are gone. Proper planning protects family futures. The future holds even more potential for change. Congress is always looking at retirement savings and tax laws. Any new legislation could further complicate inherited IRA rules. This means what is true today might not be true tomorrow. Families cannot rely on old information. They need to seek updated guidance regularly. A trusted advisor can help navigate these ongoing shifts. They can provide peace of mind in an area that causes so much stress and financial uncertainty. Ultimately, the goal is to maximize the value of the inheritance and minimize the tax burden. This requires diligence, proactive management, and a clear understanding of intricate financial regulations that impact everyone. It truly is a financial minefield.